Hey everybody, I wanted to have a little bit of fun and talk about the investing world a little bit here. What if you invested $1,000 10 years ago? What would it be worth today? So let's look at a couple of decades, right? That's important that we have a little more perspective because looking back, we've had a great experience in the stock market for more than 10 years now. Any fluctuations we've had, they've rebounded very quickly. So let's take a look at this. I picked four different categories here just to illustrate, and they're, publicly recorded performances. So that way I wasn't, taking CD average numbers and stuff like that because it's very hard. There's so many different people, there are banks issuing CDs. So I wanted to use actual public numbers that we can all go through. S&P 500, BND, the largest bond fund in the world, gold, and then the 1-year treasuries. Okay, so we'll look at the performance of those over the last decade and then the previous decade. And then we'll combine it all together. And then we're going to talk about what we learned from this. It's so important that we put some perspective and understand how this applies to our portfolio and how we handle investing. So let's go with 2015, the beginning of it, all the way through 2024. That makes it 10 years. If you put $1,000 in the S&P 500, it rocketed to $3,426. So you can add zeros all you want to that to put perspective on that. That's pretty darn fantastic. Then the bond side of your portfolio. I've been screaming for 15, 20 years, 20 years. It's been 20 years that I've been screaming, get out of bonds. Well, here you go. There's proof in the pudding. For the last 10 years, you put $1,000 in bonds, and after 10 years, you only earned $142. Bonds are dead. They've been dead for 20 years, and I can prove it because the next slide is going to be the previous 10 years, right? So we've got nothing from bonds. You put gold in there. Now, the interesting thing about gold, a lot of people don't understand is it's an uncorrelated asset. And matter of fact, when the stock market has a lot of fear and is crashing, the gold prices typically help rebound on that. So people are finding this as an uncorrelated asset. I find it a good diversification in larger portfolios. Smaller portfolios unneeded. It's an asset that if you're going to invest in it properly has liquidity issues, cost of getting in and out. You can own GLD, but this is actually just the spot price of gold. So $1,000 turned into $2,220 somewhere. Certainly way better than bonds, but not as good as the S&P 500. And then your treasuries have done nothing, just like bonds. So you can equate that 1-year treasury to CD rates. It's usually fairly close to CD rates as well. All right. So big winner, no surprise, S&P 500 for the last 10 years. But let's take a look at the previous 10 years to that. So let's look at 2005 to 2014. So 9/11 had already finished and we were on our recovery by 2005. And we know the big hit we took in 2008. But pretty much all the years except 2008 were good years in this stock market period. Okay. So we've had 20 years of really good stock market with one really bad, because you look at the pandemic, the year actually ended up fine. Crashed in the early part of 2020, and then it rocketed out of there, and it didn't look like much on the S&P 500 when you look at the annual numbers. So let's take a look at this. There's the S&P 500. There's the downturn in 2008. It did not look very good. This is a big portion of what they called the lost decade of investing. The lost decade was 2000 to 2010. It was a terrible decade. You had 9/11, then you had 2008, and nobody really earned anything in the stock market. It was a tough decade. Okay, so we only have half that decade in here. The other half was certainly very good. 2010 to 2000 through 2014 was fantastic. Okay, And I remember by 2014, plenty of clients coming in the door saying, well, can't keep going up like this. It can't keep going up like this. And if you didn't stay in, boy, did you miss out, didn't you? All right. So 2005 through 2014, S&P 500, $1,000 doubled, basically. Not too bad, not too great. It basically doubled. Bonds, yeah, still not doing anything. $1,000, you made 50% on it over 10 years. 1,000 turns into $1,500. The gold rocketed. That 2008 experience in gold was just fantastic. All the other assets weren't doing well, rocketing from gold. And then we had a big pullback in the 2013-14 range. So $2,700. So your money went from 1,000 to 2,700, and that was the big winner for that decade because treasuries really didn't do much. And the reason bonds really jumped in is because after the turmoil of 2008, because bonds went down in 2008, we pushed interest rates to almost zero, and that gave bonds a little boost here. And that's where that 2010, 11, 12 period where we got some growth out of those bonds. So a little better bond performance in that decade, but still not great. Okay. So when you look at this, you say, okay, well, I can't really pick a winner from decade to decade. We got to diversify, right? You're looking for multiple winners. You never want the losers. Well, none of these actually lost, but certainly you didn't make much money in the safe portfolio. So let's combine this. Let's look at 2005 through 2024, 20-year period, which is much more statistically significant, right? We should always be looking at our stock market as a long-term investment. So there's 1,000 turning into $7,174. $7,174. That's a great investment, right? Little bit of a roller coaster. You got your 2008, and a lot of people forgot 2018. At the end of 18, we had a nosedive. And then we had the quick little pandemic crash and rocketing out of that pandemic crash. The big winner for sure. Bonds. Holy cow, why did we invest in bonds? That's 20 years of a whole lot of nothing. 20 years of nothing. I guess that was one prediction I had right. That was pretty easy to see as far as I'm concerned when you understand what bonds are. Gold, all in all, pretty darn good asset class. The $1,000 investment in gold in 2005 turned into $6,000 after 2024. Not bad at all. Then you got the treasuries, which again have done nothing, just like the bond market. When you hit little to no interest rates, bonds and CDs and treasuries, those are all pretty terrible in terms of investments. So be careful about those. So let's kind of go through some bullet points of what we learned from all this. What do we need to extract from this experience? Well, the first part is hindsight is always 2020, right? I mean, we can always look back and say, I should have just put it all in the S&P 5. Well, I can also say you should have put it all in cryptocurrency, right? That's ridiculous. I bet on cryptocurrency, but I bet a tiny bit of money and I won, and that's great. But the reality is you can't put all your eggs in those speculative baskets. You need to diversify properly. Past performance certainly doesn't guarantee future growth. You hear that all the time because the regulators make us say it. But the reality is it's true, right? The market can keep going up. It absolutely can. There's nothing saying it can't. You look at the valuations of these companies out there, and it's complete disconnect to reality. It can keep going up. Winners and losers are different each decade. Look, I could go in and pick a handful of stocks that I think are going to win this year, and a couple of them might be right. But we have to understand then the next year and the next decade, that may be a different asset class that wins. So diversifying winners, it's important. That's going to help lift your portfolio. Uncorrelated assets are hard to find. That's why the larger portfolios look for more and more uncorrelated assets like gold. And I mean, it's getting as extravagant as funds out there that own sports teams. That's an uncorrelated asset that you can add to your portfolio. Now, that's for the uber rich to invest in and why they're able to invest in ways that we can't. Okay. When you don't need your money, you can invest more aggressively, which is obviously paid off for the last couple of decades, right? Think about that. Why do the rich keep getting richer and richer and richer? Because they have so much money that they don't need very much of their money. And they can leave it invested aggressively. And that's why that holy grail of investing talks about these uncorrelated assets and having, 10 uncorrelated asset classes that are all growth oriented. If you can invest your money and not touch it, you have the ability to grow better than anybody else. Think back to that chart. The two safe investments, bonds and treasuries, I put on there, and they were horrific the last 20 years. Horrific, especially compared to two growth assets like stocks and gold, right? So if you don't need your money, you didn't really need as much of your money in the treasuries and bonds, and you would have had more allocation to growth investments, and you would have beat everybody else's portfolio. So we have to understand that that's really what's going on here. We need to pay attention to that and how that applies to us. Other than for emotional purposes, you only need safe, stable investments in order to avoid withdrawing from down markets. You have to have a part of your portfolio you can pull from when the rest of it's not doing well. That's the only reason you need safe investments. And for some people with regular, normal-sized portfolios, that means you need things like bonds and stocks or bonds and treasuries and fixed annuities, fixed indexed annuities. You need a portfolio of safe investments, not just one. Don't rely on bonds as your only safe investment, okay? So very important. So split your portfolio from growth investments versus risk and safe investments, okay? So growth and risk on one side, safe and stable on the other side, and then build a diversified portfolio on each side. So that way, when the risk-based investments aren't doing well, you can rely on the safe, stable investments, okay? You only need those so you're not withdrawing from losses. That's how you lock in an actual loss. Otherwise, it's just turbulence. If you don't need the money and it sits in these turbulent investments, turbulence doesn't bother you because you didn't need the money. The worst thing you can ever do to your portfolio is withdraw from losses. Don't do it. In retirement portfolio planning, that's the main goal. Develop a portfolio that you will never have to pull from losses. Have that backup. Some people do 3 years of cash. Some people do, a 60-40 portfolio, 50-50, 40-60. Everybody has their own mix that's right for them. But all I really want you to do is make sure that you look at your situation logically. You can scrape off some of those profits from that risk-based portfolio to continually refill that safe portfolio. You don't always pull from your safe portfolio. You can pull from the growth part of the portfolio when it's doing well. Do not pull from it when it's not doing well. Bonds and treasuries have been worthless. If you haven't seen that, for the last 20 years, they've been worthless. And it was very logical. Interest rates were floundering around zero the entire last 20 years. When they flounder around zero, you should not be in bonds or treasuries. It doesn't make any sense, okay? Gold offers a non-correlated hedge against stock market crashes. And the reason that I keep bringing up gold lately is just because it's one of the few investments that us normal people can use as an uncorrelated addition to our portfolio, right? We're looking for other things we can invest in than bonds. Well, again, gold, I don't consider a safe investment. And certainly I don't want it in the part of the portfolio I'm regularly withdrawing from. But there is an ability to diversify with gold in your portfolio. Stay away from the mining stocks. I'm talking about actually owning physical gold. And there's even ways to earn interest on gold nowadays. So it's becoming a much more interesting category, especially for the bigger, larger portfolios. Uncorrelated diversification is incredibly difficult for us average people. And when I say us average people, can you take $1 million out of your portfolio, invest it, and not be allowed to touch it for 4 or 5 years? People that can do that can invest in ways that the rest of the people can't. Okay, so that's why it's the key to the holy grail of investing, and why rich people keep getting richer and richer and richer, because they can stock away millions of dollars in different asset classes that we don't have access to. Most of the funds that do those, like the sports team investing, the fund that does that, minimum investment is $1 million. Liquidity is zero. You have no access to it. So there's lots of things. Real estate's another one. A lot of people can't afford to just go buy a whole bunch of houses, and nor do they want to manage them. And the private REIT world is so hard to trust, but the legitimate REIT world, real estate investment portfolio world, yeah, we're talking about another $1 million. You can own chunks of large buildings and all these other wonderful things, but it's illiquid. You don't have access to it. So trying to build an uncorrelated portfolio for an average portfolio size, it doesn't work. But the much wealthier people with millions of dollars that they don't need to touch, they can stock away and let grow. Well, that's where the holy grail of investing comes in. Rich keep getting richer. And there's certainly better, safe, stable investments available than bonds and treasuries. That's why I always talk about you have to have a portfolio of safe investments instead of just having 60-40, 60% stocks, 40% bonds. We can't do that type of stuff. It hasn't worked the last 20 years, reality. It's a little more than 20 years, to be real honest, but call it all the way back to 2000. The typical 60-40 portfolio has not performed very well because the 40% did nothing. All right. I hope that helps. A little perspective, 10-year chunks at a time, looking at the last 20 years. I'm always happy to help. Yourinvestmentcounselor.com. You can book a free meet and greet with me, and always happy to help out wherever I can. I advise people all over the world, all over the United States and abroad. So always happy to jump on a Zoom appointment and help out where I can. We do full classes every single month, fpfeaz.org. You can find our full class schedule on Zoom, 800-345-3155. Happy to help. Give us a call. Like, subscribe, do all those wonderful things. You got new videos every week, and we'll see you next week. Thanks again.